You know what's fascinating? When I started tracking dealer inventories 3 months ago, I noticed something strange. The premiums weren't moving the way they should. Prices were climbing, demand was surging, but the premiums stayed relatively flat. That didn't make sense. Until now. Because what we're seeing unfold in the precious metals market isn't just another supply squeeze. It's the culmination of 5 consecutive years of structural deficits finally catching up with the physical market. And the dealers? They're running on fumes. Let me paint you a picture of what's actually happening behind the scenes. Silver mine production has been declining steadily. We're talking about a metal that's already running a deficit of over 200 million ounces annually. That's not a typo. The world is consuming more than 200 million ounces more silver than it's producing every single year. And it's been doing this for half a decade. Now you might be thinking, well, if there's a shortage, why haven't prices exploded? Great question. And the answer reveals everything about how this market actually works. See, there's a difference between paper silver and physical silver. A massive difference. On the COMEX, you can trade contracts representing millions of ounces without a single bar changing hands. It's all electronic, all paper. And for years, this paper market has been setting the price while the physical market quietly drained in the background. But here's where it gets interesting. The refineries are maxed out. Completely maxed out. Backlogs are growing by the week. What looks like a shortage isn't actually a lack of metal in the ground or in vaults. It's a lack of capacity to process it into the forms people want to buy. Think about that for a second. You've got metal sitting in vaults, but it's in the wrong form. It's in 1,000-ounce bars that industrial users need, or it's in granular form that needs to be refined into coins and smaller bars that retail investors want. And the bottleneck? The refineries can't keep up. This is creating something economists call a structural mismatch. The metal exists, but it's not accessible in the time frame or format the market demands. And when you combine that with record demand from both industrial users and investors, you get exactly what we're seeing now. Dealers are calling their suppliers and hearing the same thing. We can get you metal, but it's going to be 8 weeks, maybe 10. In a market that typically operates on 2-week delivery windows, that's an eternity, and it's forcing dealers to make a choice. Do they raise premiums to slow demand? Or do they keep selling and risk running completely empty? Most are choosing the latter. And that's creating a fascinating dynamic. Here's what I'm seeing in the data. Industrial demand for silver is absolutely relentless. Solar panel production alone is consuming record amounts. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure build-out requires massive amounts of silver. These aren't discretionary purchases. These are manufacturers who need silver to keep production lines running. And they're competing with investors who are waking up to the same supply reality. Central banks have been accumulating gold at the fastest pace in decades. They added over 1,000 tons in a single year recently. That's central banks, the institutions that print money, buying gold as fast as they can. What does that tell you about their confidence in paper currencies? But here's what most people miss. When central banks buy gold, they're not buying it from dealers. They're buying it from other central banks, from mining companies, from the wholesale market. That gold never hits the retail market. It goes straight into vaults and stays there. So the gold that you and I can buy, that's coming from a completely different supply chain. And that supply chain is under pressure like never before. Let me tell you about a conversation I had with a dealer last week. This is someone who's been in the business for over 20 years. He told me something that made my jaw drop. He said, "For the first time in my career, I'm having to tell customers I can't guarantee delivery dates. I can take their order, but I can't promise when it'll ship." This is a dealer who's weathered multiple market crashes, supply squeezes, and demand surges. And he's never had to say that before. Why? Because the entire supply chain is stretched thin. Mints are running at maximum capacity. Refineries have wait lists. Wholesalers are rationing inventory to their dealer networks. And all of this is happening while demand continues to accelerate. Now, let's talk about what this means for prices, because this is where it gets really interesting. In a normal market, when supply gets tight, prices rise immediately. That's basic economics. But the precious metals market isn't normal. It's one of the most manipulated markets in the world. And I don't say that lightly. The paper market, the futures contracts, the ETFs, the derivatives, that market is enormous. It dwarfs the physical market by a factor of hundreds to one. Some estimates put it at 500 paper ounces for every physical ounce. That means for every real bar of silver sitting in a vault, there are 500 claims on paper saying someone owns silver. This works fine as long as nobody asks for delivery. As long as everyone's happy trading paper, the system functions. But what happens when people start demanding physical? That's what we're seeing now. And it's creating a divergence between paper prices and physical premiums that's absolutely unprecedented. Premiums are the amount you pay above the spot price to get physical metal. Normally, premiums are pretty stable. A few dollars over spot for silver, maybe $50 to $100 for gold. But right now, premiums are exploding. I'm seeing silver coins trading at $8, $9, even $10 over spot. That's not normal. That's a market screaming that physical metal is scarce while paper prices remain suppressed. And here's the thing that should terrify anyone holding paper claims to metal. What happens when the divergence becomes so extreme that people lose faith in the paper market entirely? History gives us a clue. In the late 70s, gold went from $35 an ounce to over $800 in less than a decade. Silver went from under $2 to $50, and that was with far less industrial demand than we have today. What triggered it? A loss of confidence in the dollar, inflation running rampant, and a realization that paper currencies were being debased at an accelerating rate. Sound familiar? We're watching the same movie play out again, just with different actors. The dollar is losing purchasing power. Inflation is eating away at savings, and central banks are printing money like there's no tomorrow. But here's what's different this time. The industrial demand for silver didn't exist in the 70s. Solar panels weren't a thing. Electric vehicles weren't a thing. 5G wasn't a thing. All of that demand is new, and it's not going away. So you've got investment demand surging because people are scared about inflation and currency debasement. And you've got industrial demand surging because of the green energy transition and technological advancement. And you've got supply that's been in deficit for 5 straight years. What do you think happens next? Let me tell you about something most people don't understand about the gold and silver market. It's called the COMEX, the Chicago Mercantile Exchange. This is where the paper trading happens, and it's where the price is set. Now, the COMEX has something called registered inventory and eligible inventory. Registered inventory is metal that's available for delivery against futures contracts. Eligible inventory is metal that's sitting in COMEX warehouses but isn't available for delivery. Here's what's fascinating. The registered inventory has been draining. We're talking about drops of 30, 40, sometimes 50% in a matter of months. That's metal leaving the COMEX system entirely. Where's it going? Into private hands, into vaults in Asia, into central bank reserves. It's leaving the system and it's not coming back. And as that registered inventory drains, the ratio of paper claims to physical metal gets more and more extreme. We're reaching a point where the system is so leveraged that even a small surge in delivery demands could break it entirely. Imagine a bank that has $100 in the vault but has written $1,000 worth of checks. As long as people don't all cash their checks at once, the bank is fine. But what happens when people start lining up? That's where we are in the precious metals market, and the dealers are the ones on the front lines. Quick aside here. If you're sitting on a significant amount in retirement accounts, we're talking 6 figures or more, you might want to look into how gold IRAs actually work. I put together a free guide that covers the mechanics, the tax implications, how to get physical metal into your retirement account without penalties. It's in the description. No pressure, but if that's relevant to your situation, it's worth a look. Anyway, back to what's happening with dealer inventories. The dealers are caught in a vice. On one side, they've got customers demanding metal. On the other side, they've got suppliers who can't deliver on normal timeframes. And in the middle, they've got their own inventory levels dropping to levels they've never seen before. Some dealers are responding by raising premiums. Others are limiting purchases per customer. Some are doing both. But here's what none of them can do. They can't create metal out of thin air. And that's the fundamental problem. The supply chain is broken. Not temporarily broken. Structurally broken. Let me explain what I mean by that. A temporary supply disruption is something like a mine flooding or a refinery catching fire. That's a problem, but it's fixable. You pump out the water, you rebuild the refinery, and supply comes back online. A structural problem is different. A structural problem is when demand permanently exceeds supply. When the deficit isn't a one-time event, but an ongoing reality. When the entire system is operating at maximum capacity and still can't keep up. That's where we are. And it's not getting better. It's getting worse. Silver mine production peaked years ago and has been declining ever since. Why? Because the easy silver has already been mined. What's left is deeper, harder to extract, more expensive to process. And at current prices, a lot of potential silver mines aren't economically viable. So you've got declining production, surging industrial demand, and increasing investment demand all happening simultaneously. And the market is pretending everything is fine. But the dealers know better. They're seeing it in their inventory levels. They're hearing it from their suppliers. They're feeling it in the desperation of customers who are willing to pay whatever it takes to get metal. And here's what should concern everyone. When the dealers run empty, where does the price discovery happen? Right now, if you want to buy silver, you go to a dealer, you pay spot plus premium, and you get your metal. Simple. But what happens when dealers don't have metal to sell? What happens when the only way to get physical is to outbid someone else who wants it just as badly? That's when premiums don't just rise, they explode. We're talking about premiums that could double, triple, or more. Because when supply is truly scarce, price becomes irrelevant. People will pay whatever it takes. I've seen this happen in other markets. During the pandemic, try buying ammunition. Prices went up 5, 6, 7 times normal levels. Not because the cost of production increased, but because demand overwhelmed supply and people were willing to pay anything to get what they needed. The same dynamic is building in precious metals, and most people have no idea it's coming. Let me share some numbers that should make this crystal clear. Global silver demand is running at about 1.2 billion ounces annually. Global silver production? About 1 billion ounces. That's a 200 million ounce deficit every single year. Now, you might ask, where's that extra 200 million ounces coming from? Great question. It's coming from above-ground stockpiles, from recycling, from existing inventory. But here's the problem. Those stockpiles aren't infinite, and they're draining fast. The Silver Institute estimates that available above-ground silver inventories have dropped by over 1 billion ounces in the past 5 years. That's billion with a B. And at the current rate of deficit, we're looking at potentially running through remaining accessible stockpiles within a few years. What happens then? When there's no more inventory to draw down? When production can't meet demand and there's nothing left to fill the gap? The price has to rise. It has to rise enough to either increase production or destroy demand. And given how critical silver is to industrial applications, destroying demand isn't really an option. You can't build solar panels without silver. You can't manufacture electric vehicles without silver. You can't deploy 5G infrastructure without silver. So the price has to rise enough to incentivize new production, and that means significantly higher prices than where we are today. But here's where it gets even more interesting. The lag time on bringing new silver production online is measured in years. You can't just flip a switch and open a new mine. You need permits. You need financing. You need infrastructure. You need time. So, even if prices rise dramatically tomorrow, it would be years before that translates into meaningful new supply. And in the meantime, the deficit continues. The stockpiles continue to drain, and the pressure continues to build. This is what I mean by a structural problem. It's not something that fixes itself quickly. It's a multi-year process that's going to play out regardless of what anyone wants or expects. And the dealers? They're the canary in the coal mine. They're the first ones to feel the pressure because they're the interface between the wholesale market and retail customers. When they start running empty, that's your signal that the supply situation is critical. We're at that point now, and most people are completely unaware. Let me tell you what I think happens next, and I want to be clear. This isn't financial advice. This is just my analysis based on the data and the historical patterns I'm seeing. I think we're going to see a bifurcation in the market. The paper market is going to continue doing what it does. Trading contracts, setting prices based on sentiment and technical factors. But the physical market is going to increasingly decouple. Premiums are going to rise. Delivery times are going to extend. And at some point, the divergence is going to become so extreme that it breaks something. Maybe it's a major dealer going under because they can't source metal to fulfill orders. Maybe it's an industrial user publicly complaining that they can't get the silver they need for production. Maybe it's a COMEX delivery default, where someone demands physical and the exchange can't deliver. I don't know what the trigger will be, but I know the system is under more stress than it's ever been. And stressed systems break. When that happens, the price discovery mechanism shifts entirely to the physical market. And that's when things get really interesting, because the physical market is tiny compared to the paper market. And when all that paper money tries to chase physical metal, the price movements are going to be unlike anything we've seen in decades. Think about what happened with GameStop. A relatively small amount of buying pressure created a massive short squeeze because the supply of shares was limited. Now imagine that dynamic playing out in a market where the supply is actually declining, where industrial users need the product to keep their businesses running, and where investors are scrambling to protect their wealth from inflation. That's the setup we have right now in precious metals, and the dealers running empty is the first domino falling. Here's what you need to understand about market psychology. Right now, most people aren't worried about getting physical metal. They assume they can always buy it if they want to. That assumption creates complacency. But what happens when that assumption breaks? When people realize that metal might not be available at any price? That's when psychology shifts from complacency to panic. And panic buying in a supply-constrained market creates price spikes that defy logic. I've studied every major precious metals bull market in history, and they all have one thing in common. They go further than anyone expects. In the late 70s, gold went from $35 to $850. That's a 24 times increase. Silver went from under $2 to $50. That's a 25 times increase. Could we see moves like that again? I don't know. But I do know that the fundamental setup is even more compelling now than it was then. The supply deficit is worse. The industrial demand is higher. The monetary debasement is more extreme, and the leverage in the paper market is more dangerous. All the ingredients are there. The only question is timing. And based on what I'm seeing with dealer inventories, I think the timing is closer than most people realize. Let me share one more thing that I think is critically important: the geopolitical dimension of this. Countries around the world are actively trying to reduce their dependence on the dollar. The BRICS nations, Brazil, Russia, India, China, South Africa, are working on alternative payment systems. They're settling trade in their own currencies, and they're accumulating gold as a reserve asset. Why does this matter? Because the dollar's status as the global reserve currency is what allows the United States to run massive deficits without immediate consequences. It's what allows the Federal Reserve to print trillions of dollars without hyperinflation. But if that status erodes, if countries start holding less dollars and more gold, the dynamics change entirely. Suddenly, all those dollars come home. And when they do, the purchasing power of the dollar drops dramatically. That's the nightmare scenario for anyone holding dollar-denominated assets. And it's the dream scenario for anyone holding hard assets like gold and silver. The dealers running empty isn't just about supply and demand in the precious metals market. It's a symptom of a much larger shift that's happening in the global financial system. A shift away from paper currencies and toward hard assets. A shift away from trust in central banks and toward trust in tangible value. And that shift is accelerating. I want you to think about your own situation for a moment. If the dealers run completely empty, if premiums spike to levels that make metal unaffordable, if the supply chain breaks down entirely, are you positioned for that? Do you have the physical metal you need? Or are you assuming you can always get it later? Because later might be too late. The window of opportunity to acquire physical metal at reasonable premiums is closing. Not in years, not in months, in weeks. The dealers are telling you this with their inventory levels. The refineries are telling you this with their backlogs. The premiums are telling you this with their steady climb. The question is, are you listening? This isn't about fear. It's about recognizing reality. The supply shock is here. It's hitting the dealers now, and it's going to hit the broader market soon. The people who understand this and act accordingly are going to be positioned for what comes next. The people who wait, who assume everything will be fine, who think they can always buy later, they're going to be the ones paying triple premiums or unable to find metal at all. History doesn't repeat, but it rhymes. And right now, it's rhyming with every major precious metals bull market we've ever seen. The supply constraints, the monetary debasement, the geopolitical tensions, the loss of confidence in paper currencies. It's all there. The only difference is the scale. Everything is bigger now. The deficits are bigger. The money printing is bigger. The debt levels are bigger, which means the eventual price movements are likely to be bigger too. The dealers running empty is your early warning signal. It's the market telling you that the physical supply situation is critical. It's your opportunity to act before the broader market wakes up to what's happening. Because once the broader market wakes up, once the mainstream media starts covering the supply shortage, once your neighbors and coworkers start talking about buying precious metals, it'll be too late. The premiums will be astronomical. The wait times will be measured in months, and the dealers will have nothing left to sell. We're at the inflection point right now, the moment where the smart money is quietly accumulating while everyone else is distracted. The moment where positioning yourself correctly could make the difference between protecting your wealth and watching it evaporate. The supply shock is here. The dealers are feeling it first. But soon, everyone will feel it. The question is, which side of this trade do you want to be on?